Hi friends, it's good to be back. Over the last couple of weeks, it has been a range on the dollar. Dollar has been trading between 54 and 55 levels on spot. However, the Indian rupee has plunged to a record low against the euro, and it's not very far away from the lows against the pound as well. So it just shows that though against the dollar we are holding out because of the various expansionary policies of the Fed, but the structural weakness for the currency continues. We'll touch upon that part as well, but first let us outline a couple of important events that happened over the last 2 weeks or so. First, it was the IP numbers, which were surprisingly strong for the month of October, but before we get too excited about it, we have to understand that it comes off from a very low base. Last year, October was a washout. So we had a negative IP print, and this time the base was low. And at the same time, last year the Diwali was in October. This time it's in November, almost 3 weeks apart. So that creates a lot of seasonality into the data point. So those are the two factors which, in our opinion, contributed quite sizably to the higher IP print. We'll like to see whether that trend continues or not in the coming days, because drilling down within the internals of the data point, consumption was strong, investment was weak. Just look at the capital goods numbers. It's still weak. So we believe this whole trend that consumption is holding up and investment is slowing in the country continues, which is not good because it creates two major issues. One, it leads to high inflation, because if you have demand for goods which we can't produce, then what happens? The price goes up, or we import. So either ways is bad, because either the inflation or it's the issue with the currency. So that's about the IP. Now coming to the inflation part, it cooled off to 7.24 again for the last 2 months. Say this was a November number. October onwards, we are having a nice high base effect, because last year between September to September of 2011 to March of 2012, the inflation had picked up quite substantially. The base is quite high, so we'll continue to enjoy this high base for some time till March. But RBI has already indicated that inflation might inch up from the 7.24 levels. At the same time, the past data continues to be revised upward, which means inflation would stay between the 7.5% to 8% range, probably 8 quarter at max till March end, unless the oil prices really surprise on the upside due to some geopolitical event. RBI was expected to stay put and not change much, both on the policy front. They did so, but they have indicated that come January on, they might be more focused on growth than on inflation, which means we could see a possible cutting of rates from in the first quarter of 2013. So that seems to be the now, but that has not impacted the currency much, because on one hand, the expansionary policies of the Fed is keeping the dollar capped at higher levels, but at the same time, as we said, that our growing import bill and our stagnation in exports is also hurting the rupee as well. So it's not falling beyond, the dollar is not falling beyond 54. We believe over the next at least till the first week of Jan, as participation in the financial markets stay low, because most of the traders abroad, they go on holidays, we'll see a more range bound kind of a market, 54.10 on the down, 55.10, 20 on the up. Anything beyond this would require a major event to happen. And one event we'll like to keep an eye on is the US fiscal cliff, because if the cliff, which means if the US politicians are not able to come up with a plan or a compromise whereby they are able to show a pathway by which the debt in US, the government debt, would be, say, brought down, what's going to happen? Automatic cuts in various entitlement programs, and also tax increases would happen. So that would be negative for the GDP of the of US, and as well as negative for the financial markets. So that event is around the fag end of this month. So keep an eye on that. That can create volatility in a thinly in a market which is having thin volumes. So that's it. Thank you for listening.